Welcome to County Portal, your simple source for local government services and public records. Let's get started.
How long do you have to keep all those tax documents? It's a question that creates a lot of clutter and confusion for millions of Americans. You've got receipts, W-2s, and old returns piling up in a shoebox or a filing cabinet, but you're afraid to throw anything away in case the IRS comes knocking. Today, we're cutting through the confusion and giving you the simple rules so you can clean out those old files with confidence. The most basic guideline from the IRS is the 3-year rule. This means you should keep your tax records for 3 years from the date you filed your original return or the due date of that return, whichever is later. For example, if you filed your 2023 tax return on April 1, 2024, you should keep those records until at least April 2027. This 3-year window is the standard period the IRS has to audit you for simple errors or to ask for proof of your deductions. But the timeline gets longer in certain situations. The IRS has a 6-year rule if you substantially underreport your income. What does substantially mean? It means you failed to report more than 25% of your gross income. If this happens, whether by accident or on purpose, the IRS has 6 years to initiate an audit. Because of this rule, many financial advisors suggest playing it safe and just keeping all your tax records for at least 6 years. There's also a 7-year rule for a more specific situation. If you file a claim for a loss from worthless securities or a bad debt deduction, you need to hold on to those records for 7 years. This is less common for the average taxpayer, but it's critical to know if it applies to your financial situation. And then there's the forever rule. There are 2 main reasons you might need to keep documents forever. First, if you don't file a tax return at all, the clock on the statute of limitations never starts, and the IRS can come after you at any point in the future. Second, if you file a fraudulent return, there is no time limit for an audit. You should also keep records related to property for as long as you own it, plus a minimum of 3 to 7 years after you sell it. This includes the deed to your house, records of home improvements, and statements showing what you paid for stocks or mutual funds. These documents help prove your cost basis, which is essential for calculating your profit or loss when you eventually sell the asset. So, what exactly should you be keeping? You'll want to hold on to your tax returns themselves, plus all supporting documents. This includes your W-2s, all types of 1099 forms, and 1098 forms for things like mortgage interest. Also, keep receipts, canceled checks, and bank statements that support any deductions or credits you claimed, like charitable donations, medical bills, or business expenses. The good news is you don't need boxes of paper. The IRS accepts digital copies, so you can scan your documents and save them to a cloud service or an external hard drive. Just be sure they are legible and you have a backup. To sum it all up, 3 years is the absolute minimum for most people, 6 years is a much safer bet, and you should keep property records and records of fraudulent returns forever. Thanks so much for watching. We hope this video helped you clear up some confusion and maybe even some clutter. If you found this information useful, please give this video a thumbs up and hit that subscribe button for more simple tips on managing your money.